Every single day, millions of small traders log into their charts, chasing trades, chasing pips, chasing dreams. But if you look closely, the results are always the same. Most of them lose money, they blow accounts, and they walk away thinking the market is rigged. But what if I told you the market isn't against you, it's testing you? What if I told you there's a strategy, a powerful yet simple system that banks, hedge funds, and institutions quietly use to move the market, while retail traders get trapped on the wrong side? In this video, I'm going to reveal that exact approach, simplified for small traders, and explain how it turned my trading from pure frustration into consistent profits. This is the strategy they don't want small traders to know. Let's start here. Have you ever noticed how the market seems to know exactly where your stop loss is? You enter a trade, it spikes against you, hits your SL, then immediately goes in your direction. It feels personal, doesn't it? But the truth is, it's not personal. It's designed. The Forex market runs on liquidity, and that liquidity often comes from small traders' stop losses. The big players, the institutions, push price into zones where they know retail traders are trapped. They collect that liquidity, fill their large orders, and then drive the market in their intended direction. That's why 90% of traders lose. Not because they can't analyze, but because they're looking at the wrong side of the market. But when you start reading the charts like the banks do, through structure and order flow, you start seeing their footprints. And that's where the edge begins. The first step is to understand the trend. Forget random indicators and lagging signals. All you need is the 50 EMA and 200 EMA on the 4-hour chart. When the 50 EMA crosses above the 200 EMA, it signals a bullish environment. When it's below, it's bearish. Now here's the rule. Only trade in the direction of the trend. No counter trades. No trying to catch reversals. Once you have your trend, your next focus is the order block, the last candle before a strong move away. Think of it as the fingerprint left behind by the big players. That's where institutions executed large buy or sell orders. These zones act like magnets. Price always comes back to rebalance or mitigate them before continuing. So we identify the trend on 4H, find a valid order block, and then move to the 15-minute chart for the sniper entry. Let's take gold, XAUUSD, as an example. On the 4H time frame, the 50 EMA was under the 200 EMA, confirming a bearish trend. Then I spotted a massive bearish engulfing move. But before that drop, there was a single bullish candle. That's our bearish order block. I marked that zone, then switched to the 15M chart and waited. For hours, price ranged. Then, boom, it climbed back up into that exact 4H order block zone. That's when I saw a 15-minute bearish engulfing candle form, a clear sign of institutional selling. I entered my trade right there. Stop loss, just above the order block. Take profit, 100 pips below. Within a few hours, price reacted perfectly. It melted down, hitting 1.1 quickly. I closed 50% of the position, moved my stop loss to break even, and let the rest ride. The final result, 100 pips profit. But more important than the profit was the clarity. I wasn't guessing. I wasn't hoping. I was following structure and logic, the same way smart money does. Now let's dig deeper. Why does this work so well? Because it's built on market psychology. Institutions create fake breakouts to grab liquidity. Retail traders jump in too early. Banks then reverse the price, fill their positions, and drive the market in the real direction. The 4H order block tells you where that's happening. The 15M entry tells you when to join. You're not predicting anymore. You're reacting to what the market is actually doing. And that's what makes this system deadly accurate. It's not about winning every trade, it's about positioning yourself with the big money and letting probabilities do the work. Here's the part most people skip. Risk management. No strategy, no matter how powerful, will save you if you can't manage your emotions and your losses. I risk a fixed 10% per trade. I never open more than one trade a day. I take partial profits at 1-1 and move to break even. No exceptions. This approach does two things. Protects your account from deep drawdowns. Keeps your mind calm enough to follow the plan. Remember, the goal is not to double your money overnight. The goal is to stay alive in the market long enough to catch those big, high-probability moves. Trading is a game of patience and probability, not perfection. So now you know, this is the strategy they don't want small traders to master. Not because it's complicated, but because it's simple, effective, and based on how the market truly moves. The moment you stop trading against the institutions and start trading with them, your entire perspective shifts. And this strategy, the 4H plus 15M order block method, is the key to unlocking that understanding. In my next video, I'm going to show you how I refine my order blocks using one secret candle pattern that increases accuracy by almost 40%. You don't want to miss that one. So smash that subscribe button, comment "I'm ready" below, and let's keep mastering the markets, one smart trade at a time. This is Digital Hustle FX. Stay disciplined, stay focused, and I'll see you in the next video.